that they're going to do some things that at least stem the flow of money, but you should still be able to get into it.
So, Jonas, tell us about your fund. Do you like it better even if you could still get into Dagan's fund?
Yeah, because it's just a little further. And they're both great funds, and I like Dagan's, although my fund has a slightly better 5-year track record. It's got a great name, the Thompson Plum Growth Fund. It's in the top half of 1% for 5 years, yet no one's heard of it. It's got only about $128 million in assets.
But
and
Jonas,
very low. Yeah?
But Jonas, let me bring this up. I mean, with small fund companies, you do need to worry about the depth of talent. That's not really a worry at Wasatch. Is it a concern with this fund company?
Well, there's a lot of people that are, maybe you don't need 30 people who are kind of mediocre when you've got one Peter Lynch or one Warren Buffett running the shop. I mean, top half of 1% for 5 years, not for 5 months. I'm pretty comfortable with the 8 or 9 guys they've got behind this family.
Yeah, Jonas, if your fund is so great, how come nobody's ever heard of it?
One thing is they just took themselves off the Schwab OneSource system because they want to save investors money. Believe it or not, it costs money to have your fund on these discount brokerage networks, and they're almost going out of their way to stay undiscovered, besides hiding out in Madison, Wisconsin with the Badgers.
But that is one of the drawbacks of investing with a small unknown fund company. You can't sometimes easily get into the fund. You've got to call them and open an account directly with that firm.
All right, thanks you guys. Thanks to you. They're not the best funds that we've never heard of anymore. We will be watching to see how those two funds do. Coming up next, he led his team to Super Bowl glory, but can Baltimore Ravens head coach Brian Billick score with his investment power plan? Find out when we return. But first, this cash-in quiz. Nearly half of all U.S. households own mutual funds. So what is the average amount that each household has invested in these funds? Is it $5,000, $10,000, $15,000, or $25,000? The answer when Cash-In returns. Average amount invested in those funds, the answer D, $25,000. That average includes investments in retirement funds such as 401ks. Well, it's a start, but it will certainly take a lot more money to retire comfortably. That's why you need a power plan. Back with us from Los Angeles, Jonas Max Ferris, and joining us from Washington, Motley Fool analyst Bill Mann. The Baltimore Ravens, they didn't just win the Super Bowl, they crushed their opponents. So if their head coach knows how to beat the best in the NFL, does he have what it takes to beat the stock market? Let's listen to his power plan.
And I have a consistent investment portfolio that they say is a dollar cost averaging investment. And I want to know if that's a good time now to continue that, in that the market is so low, obviously on the faith that sometime it will come back up. Is that a valuable course of action? And the second thing I want to know is I watch TV every night. I see them screaming at one another on the stock market, on the floor of the stock exchange. I want to know what they're screaming at each other about. What business is getting done there?
Well, Brian, something you're familiar with. It's a lot like a locker room. The New York Stock Exchange is the largest open outcry market, so they're putting in their bids, but lots of times they're just making small talk or ordering lunch. As for the dollar cost averaging part of your question, that sounds complicated, but all it means is to invest the same amount of cash in the market at regular intervals, usually once a month, instead of investing a lump sum all at once. So is it the best approach? Let's ask Bill Mann. Help Brian out here, Bill.
Well, first of all, I'm really ecstatic that Brian would ask us questions rather than just tell us what he does. I think that dollar cost averaging is a wonderful tool, but it should be used by specific people. Mostly the people who need dollar cost averaging are those who do not have a lot of money to invest. And if Brian Billick, if that's your position, give me a call, because what you need is a new agent. Really, in this situation, if I were to go back and look at the S&P 500 5 years ago, if he were to just put his money into the market 5 years ago, as opposed to, say, putting the same amount each month from then until now, he would have about 75% more if he had just put the money in. And I think that's a very important concept, because, in general, the market's long-term direction is up.
Yeah, I mean, basically, it's better to put a lump sum in a rising market and dollar cost average, I guess, in a falling market. But, Jonas, you have a different approach, a kind of 50-50 strategy. Explain how that would work.
Yeah, it's funny you said about the noise on Wall Street, because I could watch football and people scream in the audience. I don't know what they're talking about either, but I think the coach doesn't listen to them scream because he has his own plans, and I don't think the coach here is going to want to listen to Wall Street, who's got a lot of ways to buy stock, but very few ways to sell stock. And I think he should go in there the same way he goes into a football game, coach, he's got more players than he actually plays with at any one time because he has a balanced approach. He puts some of the players in, and then he knows, a good coach knows when to put someone in and take them out. And I'd recommend with the S&P or whatever your fund is to put some money in cash or another investment that's a little safer. And when the market goes up, take some money off the table. And when somebody's doing badly, put some money in. You're playing defensively when the market's doing well, and you're playing offensively when the market's doing poorly. And it's almost a force buy low, sell high strategy.
Okay.
The thing here is what Jonas is equating is he's saying that Brian is an expert in football, but he's also an expert in investing. We believe that timing the market is very hard to do, but time in the market is the most important thing you can have.
Okay,
so,
we're going to have to leave it there, guys. Some great new insight into an old strategy. Thanks, Bill and Jonas, for helping Brian out. And coming up next, the question everyone is asking about Oracle stock. We will answer it when we open up your money mail. But first, this cash-in quiz. Health insurance can break the bank if you have to pay for it yourself. Private coverage will cost a single person about $200 a month. So how much would it cost each month to cover your entire family this way? $420, $530, $560, or $600 a month? The answer when Cash In returns. So how much does it cost each month to cover a family with private health insurance? The answer is B, $530 a month. It's no wonder the Patient's Bill of Rights is such a hot issue on Capitol Hill these days. Well, you ask, we answer. Time now for your money mail. Joining us again from San Francisco, Smart Money's Dagan McDowell, and here in our studios, Mainstay Value Fund Manager Rich Rosen. First up, Claire in New York is looking for an outlook on Oracle, both short and long term. Rich, some fairly good news out of this company in the last week. Buy, sell, or hold?
Well, I'm not crazy about the stock short term or long term. The sales momentum has deteriorated. It's still a very expensive stock. It's funny, the management talked about things bottoming out, but there's a big difference between bottoming out and growing again. And I think this company is going to have a lot of difficulty growing over the next couple of years after this technology binging that we saw in the late 1990s. I think you make more money in non-tech stocks.
Rich is right here. CEOs are not signing off on software purchases right now. A rebound in corporate profits would certainly help software sales, but that's still off in the distant future somewhere.
Okay, Ben in Georgia wants to know how the Dow Jones Industrial Average is calculated. Well, Ben, it's actually very straightforward. So much so that even the market mavens at Comedy Central's Daily Show recently tackled the same question. Here's what they had to say.
Let's start with the Dow Jones. How is it actually calculated?
Here's how it works.
Well, actually, Steve, I was going to explain.
Originally, the Dow was simply the average price of its 30 stocks. But all that changed as stocks began to split, and the divisor was adjusted to compensate. It's a simple formula. Now, it may look a little complicated.
Well, so Dagan, translate for us. It's not that complicated.
Well, the funny thing is that appears to be the actual formula used for calculating a divisor change. But just ignore that complicated equation. The Dow still is essentially an average of the prices of the 30 stocks in the index. But you can't just add up those prices and divide by 30 to figure out the Dow. Instead, you have to rely on that specially calculated divisor, which is adjusted for stock splits, spin-offs, and other events over time. And there are a lot of those events to calculate. This index is more than 100 years old.
Right. Bottom line, the stock that's the highest price in the Dow carries the most weight, and vice versa.
Exactly.
Okay. Rosa in Weehawken, New Jersey, wants to know what will happen when Prudential converts from a mutual life company to a stock company. And we saw this with MetLife. Rich, what are the prospects?
Well, I think what they're doing now is they've just sent out informational packages to 11 million policyholders who are expected to vote on whether to approve or disapprove the demutualization. If it is approved, Pru hopes to go public by the fourth quarter of this year. Then policyholders have the choice of either cash, stock or policy credits. We'll have to see how the stock, what kind of vision the stock has when the company goes out and does their roadshow, probably in the fourth quarter.
So you'd wait for that before you made the decision?
Yeah. Mm-hmm.
Okay, we got to go. That's all the time we have for this week's email. If you haven't heard your question, keep on watching. We will try to get to it. And for those of you who have new questions, send them to us at cash@foxnews.com. Feel free to send in your comments as well. Thanks for joining us for this week's Cash In. We'll see you back here again next week. Have a great weekend, everybody.